If you're just joining us, it is your number one authoritative business radio. My name still remains Charles Fakroha. Today on entrepreneurial education, we'll be looking at one important aspect of entrepreneurial venture, that is funding entrepreneurial venture, that is financing entrepreneurial venture, that is as an entrepreneur, funding, finance is also a very key aspect of your business for you to be successful. And because we know that SMEs are the engine of growth for any economy, Nigeria not an exception. So the government will try to create an enabling environment for SMEs to strive and succeed. But we know that the statistics are not too good. We have been told that for every 10 SMEs, more than 90% of them will, before they are, or after their first 1 year birthday, they will collapse and all that. So let's see how proper funding of these SMEs and some of the sources of this funding will go a long way ensuring that SMEs continue to strive and play the role in which they are meant to play in any economy. So entrepreneurial financing refers to the various sources of funding that entrepreneurs and small business owners use to start, grow, and sustain their venture. Here are some key aspects of this entrepreneurial financing. Let's look at some of the sources. Number one, personal savings. Of course, you believe in your business, you will save and you start your business. Using personal savings or emergency funds to finance a business. You can also get that from friends and family. Raising funds from friends and family members can also go a long way. Crowdfunding, raising small amount of money from a large number of people, typically through an online platform. And I know that MSEC has registered some crowdfunding companies, that have started operating in the country. And we are so happy that even the draft rule is already been exposed and it's already there. So crowdfunding is a very veritable source of funding for SMEs. Yeah, you just collect money from small amount of money from large number of people, of course, using electronic online platform. We also have angel investors, raising funds from wealthy individuals who invest in startup in exchange for equity. They see your business is thriving or you are struggling, they support you, and when you are doing well, they take part of that your company, of course, as an agreed rate. Venture capital. Okay, we've seen them. Venture capitalists, raising funds from venture capital firms that invest in startup with high growth potential. So they are there to support small businesses that they see that has growth potential. You can also have SMIDAM. Yes, that's a government agency. They can also support some of the SMEs, and all that. That is government. Even the Bank of Industry also supports some medium enterprises. Incubators and accelerators, raising funds and receiving resources such as mentorship and office space through incubators and accelerators. So this one, yes, you have your mentor. They encourage you to take a small space in their office and they monitor you and see that you grow. And of course, that is why it is incubator and accelerator. So those are some of the sources, But SMEs, again, can also approach the capital market. Of course, if they've operated for, let's say, 2 years, they can approach any crowdfunding platform. They can also look at the stock exchange. That is the NGX Group PLC. They can look at the growth board there, or formerly the ASM board, and see that they meet all the requirements. So these are some of the ways in which they can fund their businesses. Of course, we've seen other special intervention program, but the issue is the measurements and how effective some of these intervention financing options are. So what are the stages of entrepreneurial financing? There is seed funding, initial funding to develop the business idea or prototype. There is a startup funding. There is startup funding, funding to launch a business and cover initial operational costs. There is growth funding, funding to scale a business and expand its operations. There is also the expansion funding, funding to further expand a business and enter new markets, So these are some of the stages of entrepreneurial financing. What do you think? What are the importance of entrepreneurial financing? Job creation. Entrepreneurial financing helps create jobs and stimulate economic growth because once these SMEs are funded, they are operating, they make money. Of course, they want to expand, and trying to expand, they will employ more people. Innovation. Entrepreneurial funding financing supports innovation and development of new products and services, economic growth. Entrepreneurial financing contributes to economic growth by providing funding for businesses that drive growth and expansion. So the importance of funding for entrepreneurs is very, very key because we know that entrepreneurs are the ones who take the risks. Okay, so a great job, it can lead to innovation at the same time economic growth. But we have seen that there are a lot of challenges when it comes to funding small ventures. That is funding that entrepreneurial venture. It's a lot of challenge. Access to funding is a big problem today. Many entrepreneurs face challenges in accessing funding, particularly in the early stage of their operations, of their business. When they start, it's difficult for people to believe in them. And that's why we keep encouraging them. Once you believe in what you are doing, then people will see that passion in you, and that can even attract funding. Interest rate is very, very high. I mean, you go to a commercial bank to support your business. High interest rate can make it difficult for entrepreneurs to repay loans and maintain a cash flow. Equity dilution. Entrepreneurs may face equity dilution when raising funds from investors, which can lead to a loss of control and ownership. Excuse me. Some people are so passionate about their business and they don't even want any outsiders to come. Usually, family businesses, they don't want outsiders to come in, but they don't have the funding. And so that's also a challenge. They will tell you they don't want to dilute ownership. Some people tell you, okay, why not give us a loan and all that? So these are some of the challenges that affect entrepreneurial financing. But we are saying the days of one-man capital is over. And if you look at most of the big businesses today, they were started by families. And after a period of time, it becomes, a multinational, a global business. Take a look at some of the companies that are listed on the NGX platform. The Unilevers, the Nestle, the PZ, so many other businesses, even in Nigeria today. But once they are able to dilute ownership, they are listed on the exchange, then it is no longer a family business. It's now a public, that's a PLC. Then you will get support from other places and more investors will come. So we'll encourage investors to look at it very well. They are also being protected. That ownership dilution might not as adversely affect them. So let's look at some of the financial projections and budgeting. Financial projection and budgeting are essential tools for businesses, entrepreneurs, and individuals to plan and manage their financial resources. Financial projection. Yes, you want to project your finances. This involves estimating future financial outcomes, such as your revenue, your expense, your profit, your cash flow. So for every entrepreneur, you should be able to, estimate it, at least It might not be accurate, but that gives you something to work with. And estimating your financial outcomes, your revenue, you're able to estimate your expenses, your profit, and of course, your cash flow. These projections help businesses and individuals make informed decisions and make informed decisions about investment, funding, and resource allocation. So for entrepreneurs, you should be able to do some little bit of financial projection. You need to look into the future and see and look at the finances you will need in the nearest future. There are types of financial projections. You have your income statement projection, you have your balance sheet projection, you also have your cash flow projection. Okay? So when you talk of your income statement projection, you're looking at estimated revenue, expenses, and profit over a specific period of time. That's your income statement projection. Then when you talk of balance sheet projection, you're looking at estimate asset and liabilities and equity over a period of time. For your cash flow projection, you estimate inflows and outflows of cash over a specified period of time. So you might not be the one that will do some of this exercise. You just get a reasonable accountant, or there are even some software that you can use these days, but of course, you need to seek the advice of your professionals that will assist you in doing it. So those are some of the financial projections you can make: your income statement projection, your balance sheet projection, at the same time, your cash flow projections. For budgeting, which is very key, budgeting involves creating a detailed plan for how to allocate financial resources over a specific period. Just like currently in Nigeria, we are trying to do our budget, and the president is going to submit it to the National Assembly. Even you as an individual, you are advised to even have your own personal budget. A budget helps businesses and individuals manage their finances, prioritize spending, and achieve financial goals. You can't run a small business without talking of your budgets. Budgeting is key. So the budget helps you, to manage your finance very well. Prioritize spending, and at the same time, for you to achieve your financial goals. There are different types of budgets. When you run your company, you have the operating budget, outlines projected income and expenses for daily operations. You look at your capital budget, you outline projected investment in assets such as equipment, property, or even technology. You want to buy certain things that will help your business to move forward. You also have your cash budget, outline projected inflows and outflows of cash. So, and these are some of the education that we give to SME holders. There is one thing to have that passion. There's another thing for you to follow basic principles and be disciplined for your business to move forward. Yes, you will say you've been running this business for quite some time, but I'm telling you, by the time you are exposed to some of this education, you will improve your business better than what you are doing today. So the types of budget, your operating budget, your capital budget, and of course your cash budget. So what are the key components of financial projections and budgeting? You need to have an assumption. There must be an assumption. Your historical data, your key performance indicators. You have to do your sensitivity analysis, regular review, and revision. Now, for your assumptions, you clearly define assumptions about market trends, customer behavior, and economic conditions. Every budget is based on assumption, even Nigerian budgets. Now they are budgeting what is going to be the value of the naira to the dollar, what is going to be the price of one barrel of oil. Maybe it is $70 per barrel, $80 per barrel. So you must have some assumptions when you are looking at your financial projections and Budgeting. So historical data. Yes, if you have started operating before, or if you have not even operated before, you can look at similar SMEs. Use historical financial data to inform projection and budgeting decision. You also now have to have your key performance indicators, establish your KPIs to measure progress and adjust projections and budget accordingly. Budgets are not they are not cast in stone or iron. They can be adjusted from time to time. Just like even the country Nigeria, we do that. We also have what they call supplementary budgeting and all that. Okay. Then sensitivity analysis. Conduct sensitivity analysis to test how changes in assumption affect financial projection and budget. Nigeria could have said, or you could have given cost of your raw material at X price, then you try to see how you can say, okay, let's say if what if it is X plus 1 now or X minus 1, how is it going to affect the projections you have done before? That is for your sensitivity analysis. And that is why it is always good to work with your partners when you are starting out. Have different professionals, your lawyer, your banker, your financial advisor, your tax advisor, your salesperson. You can, if initially you can't even employ them, you can have them on a retainership basis. Then, of course, regularly you need to review, and revise your budget projection. Regularly review and revise financial projection and budget to ensure they remain accurate and relevant. Benefits of financial projections and budgeting: improve financial management, increase confidence, better decision making, enhance accountability. These are some of the benefits of projection, your financial projection and budgeting. If you do your budgeting very well, it will help improve your financial management. So financial projection and budgeting helps businesses and individuals manage their finances more effectively. A budget will tell you how, or show you where your money will go. You will see it, okay? And when you track it, then you know where your expenses are coming from, where you need to, adjust as the case may be. Increase confidence. Financial projection and budgeting provide a clear understanding of future financial outcomes, increasing confidence in decision making. If you have budgeted X amount for a particular item or equipment, when we are purchasing and you see that it is within that range or even less, or even above, that still gives you a bit of confidence because you have known in advance. Better decision making, of course, with your financial projection and budgeting, you can make a better decision, about investment, funding, and how to allocate your resources. Of course, and enhance accountability. There are challenges. Yes, there are challenges when it comes to financial, doing your budgeting. A lot of challenges doing your financial projection and budgeting. A lot of uncertainty because you cannot, financial projection and budget involves uncertainty and assumptions about future events. You might not be able to control what is going to happen in the future. So there's a lot of uncertainty, but we still advise that you still have your assumptions. Complexity, very complex, limited accuracy. Financial projection and budgeting are subject to error and inaccuracies which can affect decision making. They are also very complex. So the financial projections and budgeting can be complex, time consuming, requiring specialized skills and expertise. And that's why we are saying, ask your experts to do it for you. So but by understanding financial projections and budgeting, businesses, individuals can make informed decisions about their financial resources, manage risks, and achieve their financial goal. So for every SME owner, we advise that you go through this training to have that basic understanding, of financial projection and budgeting, because this will make you to take informed decisions about your financial resources. You'll be able to manage risks and achieve your financial goal. Before I close, we have seen so many of these on shows, on television, radios, and all that. Funding forward, you will see the entrepreneurs. You will see that, yes, beating the charts. You see reality business program where a lot of young upcoming entrepreneurs who go through several training. They're all, trying to get certain funding. And the basic thing they do there is pitching. So we always encourage SME owners to also understand what pitching is all about, so that they will be able to, pitch better when they are sourcing for investors. So pitching for investors is a crucial step in securing funding for your business. Here are some of the key elements that to include in your pitch. If you want your pitch to be engaging, you want your pitch to elicit the kind of reactions that you want. Start with a hook. Grab the investor's attention with a surprising statistics, a personal story, or a thought-provoking question. Just grab the attention of the investors. If you are talking, maybe you want to come up with an equipment, and health equipment that will help you maybe test your BP, sugar level at a go. Give a statistics of number of people, who have died because of they are not able to monitor these health condition, know the vitals. Then the investors who have come to listen to you, you have grabbed their attention. So start with a hook. Clearly state your business name and purpose. Your business name and purpose. You can't be pitching and I don't even know your business. I don't even know why you have that business or why you are in business. So you need to clearly state your business name and purpose. Make sure the investor understand what your business does and what problem it is there to solve. Because or what value are you adding to the customers? Problems and solution. Describe the problem you are solving. Explain your solution so that the investors will understand. Market opportunity. What's the size of the market? The growth potential. Okay, so these are things that must be on your pitch. Your competitive advantage, your unique value projection, your unique value proposition. Then, of course, the competitive landscape. Then you must also tell us your business model, revenue stream. Explain how your business generates revenue and any potential revenue stream. Because the investors are looking at the returns, payback, return on investment. If I'm going to commit X amount of money in this your business, how soon that I'm going to get my money back with some dividends, as the case may be. Cost structure. Outline your business main cost component and how you plan to manage them. Yes, they want to see your list of staff, what you're even paying yourself. So your cost structure, you need to list it out, Traction and progress. Your key milestone, maybe after 2 years, after 1 year, what are the things you want to achieve? Highlight any notable achievements such as product launch, partnership or revenue growth, user acquisition retention. Share any data on user acquisition and retention rates, that is the kind of agreement you have signed with some of your suppliers and all that. Your team and operation, I keep saying it. But you see, businesses generally, SMEs, they will get all the equipment. Make sure those equipment are first class world standard. And they will just get workers here and there without properly looking for a team. Get this team, train them, let them bond together. I don't believe that you must go and source for old hands, green hands, but train them properly. Let them understand your vision and your mission, and they can run with it faster than you. So your team and operations is very key. Founding team, introduce your team members and align their relevant skills and experience. Organizational structure, outline your business's organizational structure and key roles. So you need to look at your revenue growth, expenses, and of course your profitability. Now, when it now comes to where you want to ask, be very, very specific. Clearly state your funding asks. Specify the amount of funding you are seeking and how you plan to use it. And that is why if we apply as a stockbroker what we have in the market, the company's prospectus, when they are coming to raise funds in the market, they will clearly state the amount of money they are requiring and what they will use that money for to the last kobo. So you must clearly state that, when you are talking to investors. Tell them the amount of debts you have, how you plan to pay everything, and when you want to begin to pay them dividend. Be prepared to answer questions. Don't frown. They are not coming there to come and look at your face. They want to look at the fact, businesses. So be prepared to answer the questions they are going to ask you. Anticipate questions from investors and be prepared to provide detailed answers. That is why you are the CEO or the promoter of that business. And you are pitching to ensure that you get this funding. And these investors are not for that Christmas. They want to ensure that the money they're going to give to you will work for them. And at the end of the day, after working for them, we'll be able to, pay them some dividends by way of sharing profit with you or by way of you paying them interest if it's a bond issue. So in trying to conclude, when you want to conclude your pitch, you summarize your key points. Recap your business key value proposition, market opportunity, and competitive advantage. Then end with a strong call to action. Tell them now is the best opportunity for them to invest in your venture. Leave a lasting impression on investors and encourage them to take action. You can use a pitch like the best time to plant a tree was 20 years ago. The next best time is now. Take action and you begin to see your money work for you and of course coming back to give you dividend. So you must make your pitch very straightforward, very straight to the point, short, precise, and be confident when you are doing that. At the end of the day, you will see that investors will believe in what you have come to sell to them and they will become part of your business. Thank you.